Welcome to the All Blends Perfectly podcast. Keith, Ryan, Harrison, Coalition Properties, and friends talking about the intersection between lifestyle, real estate, culture, art, and everything in between because it all blends perfectly. Hello, good people. Welcome back to another episode of It All Blends Perfectly. I am Harrison Beecher, here with my brother, Mr. Ryan Butler. And we are missing our third partner today. There is something that's been going around the world for the last few years, and it may have inhibited his ability to be with us, because even though we're speaking to you virtually, we're going to be safe in person. The show must and will go on. And today, we're going to be talking about one of Ryan's... I'll give you some flowers, man. I feel like...
Flowers for me?
Some flowers,
oh,
yeah.
Thank
some
you.
actual flowers. I feel like you are an actual expert at this. An expert. Like, people throw around that phrase expert a lot, especially in our industry. Tons of experts. I'd argue that because you have participated in this subject in many different circles in your life and at a high level and actually done it with your own money, you're an expert.
And yours.
And mine. Yeah, a couple times. Yeah, thank you.
Yeah.
You're an expert. So what we're going to talk about today is group economics. Phrase that's thrown around a lot. And I guess I'll just open up the convo with, Ryan, when you hear that phrase group economics, like what does that mean to you? And can you define that for folks that may not have heard it before?
Yeah, I wouldn't say I'm an expert at group economics, but what I would say is that I've been a strong advocate for group economics because I believe that is the path for all types of communities to push for it and increase their wealth as a community. So, whether you're black, white, what doesn't matter. Like whatever type of community that kind of had like a little bit, hold back. Like this is how you really accelerate yourself, not only for yourself, but for the next generation.
Okay. And if we're going to define it for folks that maybe have not encountered it, this is the first time on this podcast where they're hearing the phrase group economics. Give me the layman's definition of what group economics is, please.
I'll tell you how I define it, and it's really pooling your money together to make investments. And that investment can be whether that's consumerism, whether that's investing, however you go about it. But it's investing your money together, and it's really simple in that fact, right? It's putting your money together and doing something.
Gotcha.
And that's tough for a lot of people because so many people are used to keeping their money like my money is my money. I'm gonna do what I want to do with it.
Because when you talk about sharing funds, when you talk about having your money that you work hard for, you know where every penny comes from, like you've thought about it, risk is, I think, a big part of this idea of group economics. And in a way, as we were talking before, pooling funds can mitigate a little bit of personal risk. And that's where I think a lot of immigrant communities and folks without access to traditional banking, traditional capital have looked at it in the past. But you gave a great explanation when we were talking and prepping for this earlier. Where else do people already just do group economics? Like, where does it exist in our lives already?
Yeah, I think consumerism. I mean, let's go to Vegas. Let's go to Miami.
Let's go to Greece.
Let's go to Greece.
Yeah.
We went to Greece and we shared our experiences together. That was an investment that we made. And the results from the investment was an experience.
Yeah.
Right. Sometimes the investments that we make, an investment, that's to me, they think of it more on the money standpoint, but you can make an investment in yourself. You can make an investment in your life, like personally, economically, across the board, different types of investments. So I think that making an investment in yourself, like when we went to Greece, was an experience that we'll remember forever. Yeah.
Yeah. And I feel like a lot of people, when you frame it that way and say like, well, you're already spending money together on a group experience to lessen the individual cost to you, the individual risk. Like, why don't you do that in something that's not just an experience or a one-time thing or something you get back? Why don't people do it with investment more?
Well, I think people just appreciate doing some foolishness together. I think that's fundamentally what it is. It's like, we're doing something a little ratchet together.
Yeah.
A little foolish together.
You got to have somebody you're doing what you can remember and talk about it later. Like,
exactly.
If I just do some wild stuff and I'm describing it to you, like, man, this was crazy.
Yeah, you should have came, right? That's what you're saying. Like, you should have came with me. So you want to have those same type of memorable experiences. But then when it comes to an investment, people just get freaked out.
Yeah.
And you talk about freak out of investments.
But you know what? Stay here for a second, because I feel like the group trip idea, right, is something that people get a lot, or even a big dinner, right? Like, we're going to have a big dinner at a cool place. We're going to try to economy of scale do it together. Is it not just as much fun, if not more fun, on the investment and economic side, though, when we actually do something cool together and have wins and have, like, I feel like I want to project to folks, like we're describing what it is. We'll get into some detail, but talk for a second about how great is it when, like, an investment actually works out and it's with your people and it's with the group.
Well, I think it's fantastic, but even with, say, the group dinner, there was a point in time where there's a point in time where you have different philosophies around group dinners.
Man.
Who pays, how
Lord.
you pay. I only had an appetizer. I only had a drink. We're splitting this we're splitting this evenly, and you got, Wagyu steak, and I got is that fair? Right? So there's kind of this concept, even within that, right? On the personal side of
Splitting a
things,
table at the club.
splitting a table. I didn't drink. You drank. Who's going to be a part of it?
I was in the back the whole time. I couldn't even see. Somebody spilled something on my jacket.
Yep. So all of those things, they do, they happen on the consumer side.
Yeah.
And it translates directly to the investment side, which is funny enough, right?
Can we just agree moving forward that if you're doing a consumer thing together, you pay a little bit extra for the fun of party? You pay a little bit extra to be a part of it. Like, I just get so, you know me.
Well, Harrison, you don't mind paying a little bit extra anyway.
Look, hear me out. Look, life is short. When you're on vacation, you're doing other things, man. Like, I don't want to waste time like on the extra $20 because all right, I'm not gonna go on a rant.
I agree with you. I understand how some people can feel differently.
Yes, yeah,
but we've been fortunate enough that we made an agreement with the people that we go party with that this is how we're gonna do this.
This is how it works. This is how it works. Okay, perfect example. Oh, look, see the difference now. Last time when you knocked over your mic, I just tapped this and it stayed right.
That's because you're strong, man. You're real strong.
Strong breath, real strong breath. You threw out a phrase when we were prepping, this concept of if you want to go fast, go alone. If you want to go far, go together. Can you dig into that and where specifically with group economics that it reigns true and maybe more true than other situations?
Well, I think what we found is that people who have been successful historically, a lot of times they feel alone. They might feel by themselves. They don't have a lot of people to, to go along the journey with them. Mm-hmm. And so when you've been in that space, and I've been it, you've been in it, like you just kind of feel a little bit like, hey, I got to do this by myself. I got to do it my way, so I'm gonna do it my way. Yeah. And when that happens, there comes a point where you look around and you kind of wish you had some other people with you. Yeah. You kind of wish that you weren't alone in this journey. And there are people you can talk to, but when you start talking about putting money together, it just becomes so much serious conversation and a stressful conversation because we don't always know the rules to money. Right. We don't always know the rules to money. So trying to figure out how it's supposed to work is a conversation, and that creates some of the barriers to entry into group economics. And when I talk about group economics, I'm thinking more like, and a simple example is you buy a property with some friends. Like if me and you bought a property together, to me in and of itself, that's the simplest, most basic essence of group economics. That we're sharing, we're investing together, we're sharing the risk, we're sharing the upside, we're sharing the profits.
And when people approach it, I mean, one of the main reasons why folks get into it is sometimes either the inability or they just don't want to go it alone. And that's an interesting part that I've seen of folks that utilize group economics at a high level. And this is people, $10, $100 million businesses, right? That like they had the resources to maybe do it solo, but because of the expertise of others, a great example of where group economics is on display for everybody to look at all the time is Shark Tank. Now look at Shark Tank. That's, again, it's fundraising, gaining investors, but the concepts expressed there and when they go back and forth and negotiate, that's one of my favorite parts about the show is when the investor has to work to articulate their value and what they bring other than money. And then the person that's seeking investment is trying to weigh, well, how much extra is your input worth in addition to the money? So I think that's a really good segue into when people are thinking about group economics or an idea is brought to them. Ryan, how do you weigh, kind of cost benefit analysis, risk? Like, how do you think about either participating in something with your own funds and then second, organizing things to seek people that are putting funds into the thing you want to build?
Well, I think one of the issues is that you want to, even someone who's a driver, someone who leads things naturally, they want to invest with their people. Yeah. And there's kind of two barriers to entry that I see that's consistent. One is from the other investor side, and one is from the person who's driving side. The other investor side is like, well, how much money am I? It's like the typical questions, like, so how much money am I gonna make? How am I gonna do this? What's gonna happen? And those are fair questions, which should be answered. And then there are questions on the person who's driving, which is like, man, they asking me all these questions. I'm doing all this work, and we're splitting the pot. Is that fair?
Yeah. What is the split going to be? What is the commensurate? That's an important word, I think. Commensurate, like equal.
Here goes Harrison with these words that people got to look up.
Commensurate.
Harrison again. Commensurate.
What does that mean, Harry? Don't even worry about it. You know what?
No, we'll break it down.
Break it
Commensurate
down for me.
at its simplest level means, is there an equal amount of distribution of effort, input, output, or all the things I'm putting in equal to what I'm getting out? Is what I'm getting out equal to what I'm putting in? And people think about that differently, right? So like you said, to the person that is organizing, fundraising, foreign effort, syndicating, whatever, how do they approach the math and explaining that to the people that are bringing money in? Because if you don't know, and I use unsophisticated not in a shady way, but if you are either less experienced or not as used to it, you should come in and be very like open to and listening to the person who's driving it, of like what your split is. But how does the person organizing it like frame that in the right way to where people don't get upset? So like, well, I got my money in here, why don't I get more?
Right, because in the end, you get paid for the work you do, and that concept permeates.
Commensurate. Get paid for the work. It's commensurate.
There you go. Here we go again. Harrison and all he's got a really big vocabulary. Guys, if you didn't know, Harrison's vocabulary, he scores really high on SAT, verbal, and writing. He did an amazing
Still
job.
today, Grammarly. Shout out to Grammarly. I still get my top 1.5
Top
to
words
2
of the day.
percentile of words used in emails.
Oh man.
I need to sponsor us, Grammarly. I need y'all. I use y'all. Shout out to Grammarly.
Yeah, for sure.
I got
He
good
brings
ideas.
a new word to us every day, like we're supposed to know what he is.
But when I first type it, it'd be spelled wrong. It'd be, you know me, like I go so fast, man, or I talk in my text, it'd just be like wrong. Oh man. Okay. So comparing, we talked a little bit just now about how when someone organizing an effort decides who they're partnering with and how it's split, if someone is brought, because I think this is going to be where most folks interact with this most, they're going to see an opportunity, like an investment of some kind, and it is group economics. It's a chance to put your money into a bigger pot to do something else with it. How do you look at and evaluate, and what are some tips we can give folks to like think about opportunities that are brought to them for investment for group economics? Like, what are some good signs, bad signs? Like, how do you look at those?
Well, I think just before we go there, I want to dig in a little bit more into how both a person, like people who are investing their money and then people who are investing their time, how they're looking at this. So if I'm investing, like me, I'm investing my time and my money. I'm putting in money with you, and I'm investing my time, putting all this together. It's only fair that I get a little bit extra, right? Part of the issue is how much extra.
Yeah.
Right. And that is, it's a negotiation.
Yeah.
So you kind of define what you think your value is on an investment and decide like, this is how I feel it's valued.
Yeah.
Right. And then I think the key is making sure, kind of moving to your point, is making sure that the returns that people get are enough to make them feel like they're doing a good investment, even with you taking your piece.
Yeah.
Like if I'm taking my piece and then your returns suck, I don't blame you for not doing it.
Yeah.
But if I'm taking my piece and your returns are great, like it's a win-win.
Yeah.
I think the key is just making sure that everybody wins. When everybody wins, like everybody's happy. Who's high five? Wow, you know? But like when one person wins and one person loses, it's just not a good investment at that point. Like to me, that's the fundamental piece for an investment when everybody wins.
Winning investment and business, man. I feel like it's kind of a loaded term sometimes, because winning might mean different things to different people. To the more sophisticated, savvy person, there's going to be a minimum percentage that they know they got to hit because they already got their money doing other things. But I feel like for people new to it, I feel like there's both extremes, and correct me if I'm wrong. There's either a mismanagement of expectation that they should be getting a lot more early, or they're underselling themselves and accepting a lot less. And I feel like I see that in kind of both extremes where people like don't know. So talk about that expectation and winning and how you've seen that show up.
I think that the fundamental to that is how active or passive you are in an investment.
Okay.
So when you're really active in investment, you should make more money because you're putting your time and probably your money into that investment.
Okay.
However, people don't know how to turn the switch off when they move to a more passive investment.
Yeah.
They want the returns of an active plus passive investment, even though they're only doing passive work.
Yeah.
And they'll say, why should I like invest in this when I'm only getting this type of return when I can invest this? Here's what I'm doing over here. I can get a higher return. And my kind of worse for them is like,
what you doing?
I agree.
Yeah. But
Like,
also, what are you doing? Like, what are you actually doing that's different in both situations?
Correct. Yeah. And there needs to be a ratio that you choose that has passive and active in it. You decide what that looks like. Maybe when you're younger, it's a little bit more active, right? You can do a little bit more work. And then when you start to age, I mean, my grandmother doesn't want to sit around like managing these houses. Actually, kind of likes it a little bit. All right. Actually, you guys gonna hear me shout out to Dorothy Butler. Shout outs. So you gotta hear me talk about her a lot because I've grown up and just seen her be a businesswoman, small town businesswoman. Yeah. Is what she is. Yeah. And so she likes putting money in and getting the money back and like consistency there. Yeah. Right. And so depending on where you are in life, or if you're, some of the people that do really well, it's like if you run a practice as a doctor or dentist or lawyer, like you're spending 50, 60, 80 hours
actively in the thing that makes you the most money.
Makes the most money. But then what's going on behind the scenes? Like, is your money making money for you? Yeah. So those, like, if your money's making money for you, like what type of return should you be getting? Right. I always look and say, what is the stock market doing? Kind of do math based around that, because that's something that everybody knows. So if you are having a return that is at or above the level of what the stock market gives, then it's probably, in most people's minds, at least a fair investment.
Yeah. Because they got another thing they could say, if I didn't do this with my money, I could be getting that. And I feel like that's a part of the win and fair. If it's upside, the other piece of it, which I think is something that you've been really good at, is framing the opportunity to be a real estate investor. Because I feel like a lot of people want to say that and say like, oh, I'm a real estate investor. I do that. I'm a multifamily investor, right? I feel like there's a little bit extra, even if the returns are like identical, only a little bit better, there's something that's kind of intriguing. And I don't know if it's bigger pockets or earn your leisure or something over the last like 5-6 years. Like, it is something a lot of people have wanted to say they are and are doing. And your type of group economics at the highest level, the syndications, give people an opportunity to do that. And the returns are great. The returns are very good. And there's other tax benefits when people are real estate professionals too. But I feel like that is another piece of it. In addition to knowing what else could I do with my money, it's how does like the win is like, how does this make me feel for being a part of it? Like being a part of this group, how does it make me feel from an identity standpoint, from how I can talk about it standpoint? Because I think that matters. I think that like is a piece of the equation in addition to the return.
Well, I think what you're saying is exposure and access to alternative investments.
Yes.
That's really what it is. Because we've heard about stocks and bonds for the longest period of time. We've heard about retirement accounts, IRAs, 401ks, 203Bs, all of these types of retirement accounts and all these types of more traditional investment vehicles. We've heard about standard real estate, buying a house and fixing it up and keeping it or renting it out. What we haven't had as much access to is alternative investment.
Allergy season.
Oh my God, it's allergy season. Hey, it's my fault, y'all.
All spring. No, man. I think of you whenever there's that, I think it's a Claritin or Allegra commercial or whatever, where there's that
you think
big
of me?
like monster. Yeah, I think of you. That monster be coming, it's like a flower that morphs into this like crazy monster, like attacking people. Like, oh, it's coming for Ryan.
Oh
it's
man, if I could fight my allergies, I would fight them. Like, I would punch them in the face.
Imagine your locks throwing all over the place.
Because they're punching me and I'm like, and I just want to hit them with one good uppercut. Like, this is for you. Oh man, what was I talking about? Alternative investments.
Yes.
All right. Here's the thing.
Because it's different.
Here's examples of alternative investments. Right. You have people who invest in syndicated real estate from a group economic standpoint. You have people who invest in funds. Right.
REITs.
Like REITs. You have people who invest in venture capital. So the big three that I think of typically are venture capital, private equity, and then you can look at private equity as real estate as well.
Yeah,
typically,
but
but also
different.
there's like businesses. People invest in funds that put businesses in there, and then you have like.
And I'll just say before you go deeper in it, assuming someone hasn't heard it, like what you're describing are these pools of funds. Like there's a main organizer that allows you to put X amount of dollars into this big fund, and this fund then goes out to do stuff with it, and they give you a return, some projection on the amount of money you'll get back from your original input in.
Right. So, for example, venture capital is like if you invested in Facebook early, right? Private equity is if you invest in a fund that goes and buys small companies and pulls them together and kind of bring their resources together and streamlines their systems and puts marketing and that kind of thing. And they make a return from that. And then you'll have, even on the financial side, you'll have other types of funds that the Wall Street guys have for alternative investment, where someone is like actively trading stocks day in and day out, right? So those are alternative investments, like hedge funds, for example, right? So those are alternative investments, which historically most people don't know about, and just like that's any type of person, right?
That's just people, because let's be honest, like how many folks have had enough disposable income to have all my stuff taken care of, my regular buckets, and then this extra set of funds that's just out there to try to make me more money. Like making money for just being money is something that a lot of people don't have access to. Like, I mean, I don't know the percentages, but like,
and the ones that did, they were, there's a level of fear that comes with it.
Yeah,
because what the stock market, like, there's the ups and the downs, but we know it goes up. Same thing with real estate. The ups and the downs, it historically just goes up over time. Right. But these alternative investments, they're alternative. Yeah. That's the reason they are. So
big wins, big loss. I mean, risk to win big.
Because, there are companies on the venture capital side that go, up in, right? Yeah. They go bust. Like 1 out of 100 is a win in that world. And
but when they do go big, and I feel like we've had such an interesting, say 20 years, right? Like just what's been happening from the tech side, from this app side, from like all these other things kind of coming out of the woodwork, and they get so much enthusiasm and excitement, and people are like, oh, I'm a part of this like new thing. But it's interesting. My perspective on that is, I'm like, man, I didn't know about it. Like by the time I hear about it, I'm like, oh, well, there are other rounds where you can still participate and get in. But if you want to get you something, you can take a quick break.
Second.
Yeah,
we'll take a second.
Yeah.
Okay.
So we can wrap shit. Where were we at?
So I was crying.
No.
Are we ready?
Yeah, you just go right
so
back.
So I apologize because I got real sensitive with Harrison over here. There were a lot of tears that came down my eyes.
Actually, it was just one. It was just one thick tear.
One single thug tear. One single thug tear that came on the left-hand side over here. So I'm sorry, Harrison. You my guy, man. I just had to give you, show you.
I mean, I kept eye contact. I ain't
break with you. And we kept going. I kept going. You looked me in my eye like a man.
Well, that one tear just slowly ran down.
Oh man!
Oh Lord!
I don't know what we were talking about group economics. It was a type of alternative investment.
Yes, alternative investment. That's what we're talking about.
So I think we were just talking about the types of alternative investments, and one of the reasons is that, of course, you got to fill up the basic coffers that you have with the retirement accounts, etc. And at the same time, you just don't know about them. Yeah. And so your willingness to take on a risk with your money for something that's, I mean, even the term is called alternative. Yeah. That means that it's different than like what's normally being done. Yeah. So like having alternative investments, but if we're being honest, that is where the highest levels of wealth and income will be made through these methods. They 100, like you can't.
Now, is that
tell me that that's not going to be the case? Why? That's because the returns are so high. Okay. Because they're significantly higher than the standard.
Because the risk is higher.
Because the risk is higher.
Yeah, that's why the returns can be so high.
For sure. And there are people going to lose. Yeah. But the people who win, they're going to win pretty big. Yeah.
I always think of those. All the commercials for financial services or other things. The disclaimer at the end is investing in securities involves the risk of loss. right? Like they say that all the time. And I feel like with group economics, like that's a disclaimer that we give and that we are giving now to people, is that there is the risk, but there are levels to that risk.
For sure.
And question I got for you, is it possible for me to invest in a group economic opportunity, something that's brought to me with minimal cash in? Can I make a lot of money? Is it possible with a little bit of money in, a lot of money? I'm talking like hundreds or even thousands, because I feel like that is a space where a lot of people might interact, like stuff might come to them, opportunity, deal. Is that still a thing? Like where I could make a lot of money on the back end with minimal money and risk up front?
Well, you can. There are opportunities for that, but that's usually a private deal.
Okay.
So, for example, if I have a deal and I need, say I buy a deal and I got it for 70 cents on the dollar, or 50 to 70 cents on the dollar, which is a great deal, right?
Yeah.
However, I don't have enough cash to get the deal done. So I still need some cash to get the deal done. That's like probably an example of where you can make pretty good money in a short period of time.
Okay.
Right. But that's a risk.
Yeah.
Right.
And the person leading it, and that's going to be one of my wrap-up questions. How do I know the person's legit? Right.
Yeah.
What are some things that like, because this is an unfortunate, maybe it's kind of a dark side of some group economics, especially in, immigrant, Black and brown, new to money communities, is that there are scammers out here.
Yep.
They're real scammers. So how can people think and evaluate like that it's legit and that the returns actually might be good, or like how do I think
basic things like looking anything else, like you look at track record. So if you're putting some money with somebody and they're like, hey, I'm gonna make you a lot of money in 5 years, well, have they done it before?
Yeah.
And if they've done it before, like show me.
Yeah.
So I did over here, in my space for syndication, we call them the exits, and they're exits across the board, but like an exit. So how many exits have you had? And what were the returns overall once you actually exited that deal? Because usually in real estate, it's a combination of the equity that you make from buying it at one price and selling at a different price, plus the cash flow. Yeah. So what did the exit look like? Right. You can also say that for venture capital as well.
So asking people to show you some receipts and say, if you're asking for money from me today, where have you done it before?
As the stuck tear comes back.
It's about to come. Oh, there you go. There's
going,
the one. There's the one.
Oh!
Zoom in.
Do you see me?
Oh man, had a tissue. We got everything in this office, but no tissue.
Oh my god!
But if you're doing anything, and that's just general like due diligence. I mean, that's a main.
Yes,
If somebody leaves this conversation hearing like, "Oh, group economics, cool idea," you still got to do due diligence. Like you always have to.
You got to do due diligence. You need to talk to people who've invested with them before. Like, hey, who are your other investors? Can I talk to them? Right. What are your exits been? Show me your exits. Show me the properties. What you bought them for. What you sold them for. What was the return metrics that you use, and did you hit the metrics you promised? Because in the end, a lot of it really boils down to just doing what you said you're going to do. Yeah. And if that person did what they said they were going to do, it's a lot easier to trust them. And like that doesn't matter what that's just life, right? So if you said you're going to give me a 15% return average year over year, and you give me that, that's a win for me.
That's
like
great 15%. That's great return.
That's great money.
Outpacing a lot of other traditional vehicles.
Pretty much all traditional vehicles. I can't think of a vehicle where it like
fair point.
So that's really high. So I think it's just really about doing your due diligence, not only on that person, but like what's the industry standard for what's going on there?
What should you expect? Yeah.
What should you expect across the board? What this person does individually, and your risk tolerance for that.
Yeah. And how well can that person both demonstrate that, explain it to you, and show not just the examples, but like I want other people that you've done this with, right?
Yeah,
and that have had a good return, especially if we're talking about significant sums, which, for most people, 10, 15, 20, 25, 50,000, right? Which is kind of
100, $250,000.
Yeah. Which I mean, those are all realistic entry points for, things you've had to do. That's real money to folks. They worked really hard for, and you have every right. And if someone gives you pushback and is like either can't provide it or the answers aren't good to it, that's a red flag, right? Like
for sure. And there are going to be people who are starting and they don't have as much experience. They are not as skilled. They don't have the background, and you have to wager what that risk looks like, right? Because I've definitely screwed up.
Yeah.
Now, luckily, that was like 15 years ago.
A lot less to use, a lot less to lose, right?
A lot less. No, it was other people's money. You know, I lost 150 grand on like my fifth flip or something like that. So I had made a bunch of money on my flips and lost it.
But here's what made you, and here's why I still give you my money to do. You paid everybody back. Like you made that a serious point that was like, before you're handling anything else, you got to settle all your debts. And like that's, I think the integrity of the two people on the side of the people involved in group economics, whoever that leader is, integrity and trust, like in any business dealing, but especially when it's your discretionary money, that's super important. And that's a real thing why we invest with you, why the opportunities you bring to us in our community are significant and different, is because we know you're not going to mess around with our money. Like that's it's important to you personally.
It is. And, Warren Buffett says the first rule of investing is don't lose money.
Yeah.
So even if you don't make any money, if that person returns your capital, you might not even do business with them again, but there's a certain level of respect and dignity around returning the capital. And so I would even say, what do deals like that look like, right? An example would be, we just closed on a 100-unit apartment building. We haven't really been able to talk about it too much, but we just closed on a 100-unit apartment building in right outside Atlanta, Georgia. And we bought that for $6.5 million. And we had to raise $2.5 million to get this deal done.
Yeah. Through the midst of a lot of economic challenges, inflation, like a lot of reasons why that money should not, it just made it more difficult to get there, but you did it. And the closing.
And even getting to the closing table, delays, 3 months later than we were supposed to close, right? And that's the type of deal where it's not just the stock market. Now, we can watch and see, everybody can see what the stock market is doing. But from an alternative investment standpoint, you're really kind of like going with the ebbs and flow of the economy plus this person that's working on your behalf. Yeah. And it can be really scary.
And they got to stay on it too. The biggest thing that I'm grateful for from being in the general limited partner side of it, right? Like, because there's definitions of the folks kind of organizing, driving, putting the most risk, the most time, the most effort in.
Those
and
are generally the general partners.
And then just people with cash on the other side. It's great to know that the general partners are on it, right? Because they both have personal investment and just a desire to like actually get the deal done, which is extremely important when anyone is valuing out a project. Like, you got to understand, like, is this person driving it going to keep driving and going to get it done?
Yeah. And that's why they're getting paid.
Yeah, they earned
in the end. They're like, all right, this person's working. You finally looking like, all right, I'm glad I'm not doing that, and I'm glad that person's doing that. And so you'll even see that with like, speaking of alternative investments, kind of wrap this up. I mean, we even have Mitch and Tristan, right? Who have
High Street Equity Partners.
High Street Equity Partners. Shout out to them. Shout out to Mitch and Tristan, High Street Equity Partners. They have a fantastic fund, and you can tell by the type of people who invest with them. Yeah, you can tell by the process and the rigor that they go through to vet companies. How good. So it's interesting seeing someone outside of myself doing the same thing in a different lane, and I want to put my money with them.
Different product, but same work ethic, same hustle, same drive. And let's be real, man. Like, I feel like we were joking a little bit earlier about generational differences. I feel like us millennials now are in a kind of prime income earning stage. We're in a prime kind of industry leadership stage. We're getting there. And I like the way we look at things with not the same kind of status quo approach that maybe our parents had, but with not this completely open-ended, crash it and rebuild it that Gen Z or behind might have. So I think I bring up them specifically because they are people that I look at and just trust on a lot of different levels. And that core trust and their ability to have receipts, having done it at a bunch of different levels, makes them really good people that can lead a group economic effort. And I think as folks value, like, that's something. So, I mean, millennials running stuff anyway, just because we're our age, but like, those are important factors when you're deciding who you're going to deploy your capital with.
Yeah, because in the end, if the money is not out working, it's not helping you. Yeah. And you can save up a bunch of money, which is great. But investing is how you build your way to wealth.
Offense instead of defense, right? Like you can.
You need them both.
You need them both.
You need to have reserves. You need to have cash in the bank, etc. But anything else needs to be out in those streets working.
Yeah, if it's not working, especially in an inflationary environment, like legit, if the money is just sitting in your bank account right now, you're actually losing because the value of the dollar is not what it was before.
Like Future said, money should be for the streets.
Love it, man. All right, so as we kind of wrap this conversation up, is there any final bullet point or something you want somebody to leave with when they think about or hear group economics in the future?
I think give it a chance. Mm-hmm. Think about it. At least hear somebody out on it. And you have the right to say no.
Yeah.
But you should be open to that because especially a lot of people feel behind in their financial circumstances. And they feel that they have to work a 100-hour work week, blah, 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 to move up. And this is a way to help accelerate your wealth and your growth.
Love it. Yeah, money working for money is one of the key factors of some of the wealthiest people in the world. So utilizing group economics and thinking about that as a conduit that can help you get started on the wealth building journey and having your money work for your money is something that we love to talk about. So thank you so much for plugging into us with this conversation today, Ryan. Thank you. My
Even
resident,
with all my tears, all the thug tears I laid down.
Two whole thug tears come out. That means this is an important conversation to him. Make sure you check us out on all social media channels at All Blends Perfectly. I am at HL Beach. Our team is at Coalition Properties. He is at Ryan Butler Hoya. And even though Keith ain't here, he is at Keith James Realtor. So you can follow him too for great content. And make sure you join us for the next episode of All Blends Perfectly.